Retail traders love chaos. They chase the massive, unpredictable whipsaws of gold or the high-octane swings of the pound-yen. But professional institutional desks do the opposite. They look for the charts that smooth out into a boring horizontal wave, and their favorite anchor is the euro-pound. This diagram shows the trap retail traders fall into. The euro-pound only moves about 40 to 60 pips a day, half the volatility of a standard major pair. To a retail trader looking at these numbers, the logic seems obvious. If the daily range is half the size, they just double their lot size to make the exact same potential profit. But doubling that leverage creates hypersensitivity to tiny market movements. Because the cross-pair math is different, the actual dollar value of a single pip on the euro-pound is often higher to begin with. Add a doubled lot size, and a standard 20-pip stop hunt, a minor blip on any other chart, suddenly represents a massive, account-draining drawdown. This math catches intermediate traders entirely off guard. They see a slow market and assume they are stepping into a low-risk environment. In reality, intermediate accounts die here because they try to force aggressive, trend-following strategies onto a market governed by an entirely different set of rules. The euro-pound does not trend, it mean reverts. The United Kingdom and Eurozone are economically fused. They share borders, trade agreements, and supply chains. When they face inflationary pressures or economic hurdles, they usually face them together. You can see that relationship on this chart. Market forces act like a gravitational pull. If the euro gets too expensive, it chokes exports, making British goods cheaper. That imbalance naturally forces the exchange rate right back toward an equilibrium. There is only one catalyst strong enough to break that gravitational pull: a direct conflict in monetary policy between the two central banks. If the European Central Bank holds rates low to stimulate growth, they are weakening the euro's yield. Conversely, if the Bank of England is simultaneously raising interest rates to fight inflation, they are strengthening the pound. Tracking that specific divergence in central bank language is the only verifiable way to know when the euro-pound will snap its horizontal range and execute a 100-pip breakout. Short of a central bank shock, institutional traders execute their mean reversion strategies within a 3-hour window, the London session overlap from 07 to 10 UTC. This is the only time there is enough real volume to validate a setup. During this window, big desks engineer what smart money traders call a Judas swing, a deliberate false price spike designed to trigger retail stop losses and absorb their liquidity. First, they mark the overnight Asian session's boundaries with a ceiling and floor. Next, the liquidity sweep. Price pokes above the ceiling, trapping retail buyers. Banks immediately sell, driving price inward. This bearish order block becomes the entry, targeting equilibrium. Professional execution here requires total discipline. You never buy the breakout. You wait for the sweep, fade the extreme, and ride the gravity back to the mean. Professional desks love this pair, exactly because it is boring. A market that has an 80% mathematical probability of staying within a tight box for 6 months provides a massive stabilizing anchor for a broader trading portfolio. Even if you prefer trading the US dollar, this pair acts as an essential diagnostic tool. Look at this logic tree. If the dollar is weak, which European major do you buy? You check the euro-pound. If it's bullish, the euro is the alpha. You buy USD. If bearish, the pound is the alpha. Buy pound USD. The volatility paradox only traps traders who expect every chart to behave like a rocket ship. It's time to stop over-leveraging the chop and start executing with the precision of a quantitative desk. You can eliminate the guesswork by downloading the FXNX Euro-Pound Range Trading Checklist and using our automated strength meter to identify your next high-probability setup. Tight range trading requires zero friction. The FXNX NX1 account delivers exactly that, providing institutional-grade 0.0 pip spreads, so you keep the margins you capture. Join thousands of traders on FXNX today, secure your institutional anchor, and start trading with a true quantitative edge.